Before we all got together, I'm not sure if any of you have been checking your email this morning. Hannah sent out an email with a link to the shared folder for this webinar. There are materials that we'll be referencing, but we also want you to be able to reference them afterwards. I'll be showing them on my screen, but if you are the type of person that likes to follow along with your own materials, they're there for you as well. I will say that, if you only have one screen, it might be easier to just follow along with us. If you have more than one screen, when we look at some of the financial documents, it might be nice if you have them open on a second screen so that you can kind of scroll around and see what you're looking for. But I'll walk you through what they are as they come up. So just very quickly, here is what the folder looks like. You should all have access to this. If you don't, please let Hannah know. There's a couple of different documents we'll go through in here, and then a copy of our slide deck. Okay. Can I just, I feel like almost everyone's video is off. There's a couple. Can I get a thumbs up if you can see my screen? It's just the title of the slide deck. Thank you, Danielle. Okay, so here we go. We're going to talk about lender readiness today, and we're going to cover a few different topics that lead into that conversation. My name's Rebecca Frimmer, if you didn't catch that already, and I'm with Kitchen Table Consultants. I live in Morro Bay, California, but I did used to live in San Diego, and I'm originally from Philadelphia, where KTC started and was born in 2009, and I've been working with this organization for just about 10 years. So we are Kitchen Table Consultants. We have a sister company called Taste Profit Marketing. We merged last year. Taste Profit handles marketing and marketing execution. KTC handles financial and business consulting and bookkeeping. And our goal and why we're here and why we're doing this is to help farm and food businesses stay profitable for good, meaning forever, and also for the good of the planet. We are really trying to help push forward sustainable farming and food manufacturing systems, and also the parts of the food system that support them. So these are some things that we do, which I did just mention. We're going to talk a little bit today about strategic planning also. And we operate by 4 principles within our organization. So we hold ourselves accountable to some brutal honesty, really hard work, and a commitment to the value of the work that we produce, helping others improve their businesses and their lives. If you haven't met me yet, I definitely see some new names in here, but I do know quite a few of you. Like I said, I'm a partner and principal consultant at KTC, where I've been working since 2014. My background comes from general management. I have an undergrad in marketing and a master's in business administration and small business development. And throughout my career, I've been a general manager in a lot of different spaces, in hospitality, in specialty food retail with e-commerce. And then, before I joined KTC for a few years, I was the general manager of a nonprofit and urban farm in Philadelphia that had a number of different programs that touch a lot of the work that you guys do. I've owned a number of businesses as well myself, in farming, catering, entertainment, and now as a partner in KTC. So I like to focus on financial analysis and taking the MBA piece of the work and bringing it to all of you so that you can better manage the financials in your businesses. And I really enjoy building trainings like this, where I get to help a whole lot of you make steps towards business improvement. I do work pretty consistently with San Diego Food Systems Alliance. Me and my team and myself are on the business planning advisor team with the local food economies lab. So some of you here are already working with us through the lab and helping you fine tune and develop your business plans and budgets. And thank you for that opportunity. It's a pleasure working with all of you. All right, so enough about me and KTC. Here's what we're going to do today. We are going to do an initial review of financial statements, and we're going to talk a little bit about some of the material we covered in our financial literacy training that we did in person in San Diego, was it 2 months ago now, something like that? And then we are going to dive into lender readiness. What does that mean? What do I need to equip myself with to go out and try to raise or borrow funds for my business? And then the third section of this presentation is going to be about business performance. So we are going to talk about ratios a little bit. Don't get intimidated by that term. It just means fractions. We're going to talk about, what numbers we want to crunch, why we want to crunch them, what they mean, and how they help us tell the story of our business, especially then when we want to go out and ask someone to believe in us and invest in us or lend us money. We need to be able to tell that story. We need to be able to tell it in a way that makes sense over time and when we look at the financials, that they hold up the story of the business. And then we're going to talk a little bit about how to ask, and then we'll take questions. Although I did say we'll take a couple breaks for questions at the end of each section. So here we go. I'm going to check the time. Okay. All right. So just some framing for today. Our intention is to provide a format for financial analysis for your business that helps you discover what drives your business, where it's going, and what issues might require your attention, right? So when we talk about financial analysis and building it in a specific way, the reason that we want to do that is so that you understand the why behind the numbers and the dependencies between the numbers, how they're connected, where you have control and where you don't. And so you can focus on things that are going to be meaningful and impactful for your business over time. The second thing about our intention today is comfort, right? We want to be comfortable. We want to be confident talking about our business performance so that you can do it with authenticity, right? If you want to go and talk to a lender about borrowing money, or go even talk to like your auntie about borrowing money to fund your business, you want to be able to tell that story from your heart. You want to be able to understand the words that you're saying, and you're not fudging it, right? You've been through the numbers, you have some level of comfort, and you have an understanding of how you will pay that money back. Okay. So my business partner, Ted, who's been a friend and a mentor of mine for over 10 years now, always says, borrowing money is easy, paying it back is hard, right? So if you can make the case, it's not as hard as you might think to get a loan or to get an investment. It's really understanding how and when you're going to pay it back and following through with that can be really challenging. So we want to train you, number 3 here, to have an understanding of your financials and your business plan so that you can approach a lender or go raise funds with confidence, right? It really is just that next level of number 2. Section 1 of this presentation is a review of some of the material we covered in our financial literacy workshop, but we're going to go a little bit further with a couple of things here. So we'll start with this. All businesses have financial transactions, right? And those financial transactions are usually organized and presented through a financial accounting system. That financial accounting system so frequently is QuickBooks Online, but there are other systems, and even systems that are free or very low cost, that do a very good job of getting pretty close to what you can get out of QuickBooks. So some of my clients that I've worked with in your community in San Diego in the past have used Wave, which is another accounting app that's very low cost. But the point is, or some pretty fancy Excel spreadsheets I've seen as well that do like sorting and pivot tables to create the frameworks of financial statements. There are options. The point is that if you want to go out and you want to borrow money to scale your business, you're going to need to have financial statements. At that point, you're beholden to your lender or your investors, and you have a responsibility to provide information about your business performance. So if you're at a very early stage in your business, it's never too early to start with an accounting system, a bookkeeping system. So they do require some training. And there are also, just a word of caution, a lot of like uninformed bookkeepers out there that just sort of have self-taught themselves QuickBooks and might not be doing everything under the appropriate principles to give you the right information in your reports. So even if you are bringing on a bookkeeper, interviews and references are really important to make sure that you're getting someone that's going to support your goals. I've had to untangle a lot of messes over the years from somebody who hired on a bookkeeper that really wasn't experienced enough to do the work that they needed. So that's just a little word of caution. I don't want to start with bad vibes, but just be careful out there. And so there's 3 financial statements that come out of these accounting systems, right? Or if you're doing them yourself in spreadsheets that you would need to try to create. Those 3 statements are standard. They are called the profit and loss statement, which is also called the income statement, right? If you've heard it called that before. There's the balance sheet, and there's a statement of cash flows. Usually when we're talking about beginner financial training, we usually focus on the profit and loss first, and then we move on to the balance sheet. Statement of cash flows in its standard format isn't utilized as much, but I want to show it to you so that you can understand the principle and how we want to incorporate that knowledge into the work that we're going to build today. A couple of key points, right? What are these statements and what do they do? The profit and loss statement is a record of all of our income and expenses in the business, right? So I tend to lean towards like examples that step away from farming and food for a minute, just so that we can all be on the same page. So like if I go to the coffee shop, my favorite coffee shop in San Diego is Heartwork. If I go to Heartwork and I get my coffee, my lavender latte, right? They have income, I'm buying the latte, and they have expenses, right? They're going to put beans in the machine and milk in the frother and in a cup with maybe a band and a lid. But then there's also the overhead, right? They're paying employees, they have the store, all of those things, right? The profit and loss statement captures all those income and expenses over a period of time and drives out profit on the bottom line. The balance sheet is another income statement that shows all of the transactions that really don't appear on the profit and loss statement. So when you think about a business over time, it's like, well, what are we doing that's not on the profit and loss statement? Well, we probably have some investing activities. We're buying equipment. We probably have some financing activities. We're taking out loans to finance those pieces of equipment. And so what makes up the balance sheet is this equation that you see right here, right? Assets, the things we own, equals liabilities plus equity. The things we own equal the money that we have borrowed and the funds that we and others have invested in the business, and also the retained earnings we've held over time. So when we look at the balance sheet, whereas the profit and loss is over a time period, a week, a month, a year, whatever, the balance sheet is one moment in time. So as of right now, today, if I pull the report now, what is the net worth of my business? This is what the balance sheet tells us, right? We have things we own, we have things we owe, and we have funds that we've invested in the business. So if we had to liquidate tomorrow, what would our business be worth? And so the balance sheet gives us information about all of the off profit and loss statement transactions. And even though generating profit is really important in a business, sometimes when we're in a situation where we're borrowing or we're asking for funds, the balance sheet takes its time in the spotlight. So it's important to have this piece put together. The statement of cash flows, which is sort of like the lesser known of the major financial statements, bridges the gap between income and cash flow, right? So if we think about our profit and loss statement, I'm doing a catering gig for this corporate office and I go bring it and I deliver them an invoice and they don't owe me money for 30 days. So in that case, right, that income will be captured in the profit and loss statement because we invoiced them, but we haven't received the cash yet. So the statement of cash flows covers those gaps.
Just a minute.
I think we have one person that's not muted. If you could possibly mute, that would be great. I don't have the power to mute people.
I did, yeah.
Okay, thank you. And the statement of cash flows is also over a period of time, and this helps us understand our ability to pay back our debts. All right, we'll take a look at these in just a minute. So we've talked a little bit about chart of accounts in all of our trainings, but since we have some folks here today that haven't joined us, the chart of accounts is the listing of every account in your accounting system. So it's really just a list of categories or names. So at this point, I'll just take a second and show you guys a small farm profit and loss statement as an example, just so we can help understand some of these terms. This is in the folder for you all. Make this a little bit bigger. Here's an example of a small farm profit and loss statement, right? So all of these names, right? Packaging, seeds and plants, single-use supplies. These are all of our accounts in the profit and loss. As you can see, there's all different kinds of parent and subcategories. And then at the bottom, we drive out our net operating income. We look at some other types of income and expenses that aren't directly tied to our operations. And then we're able to drive out net income, which is also known as net profit. So in our chart of accounts, right, that list of categories, hold on one second for me, friends. I want to grab one more document. Here's also an example of the balance sheet, right? So this has accounts too. What do we have in our bank account? What do we have in our cash box? What do we have in PayPal? What are some of those accounts receivable that we're waiting for to be paid? So this list of names, and if you came to the financial literacy workshop, we gave out templates for both the profit and loss and the balance sheet chart of accounts. This diagram kind of explains how everything's related, right? So the income and expense accounts go to the profit and loss statement. The asset, liability, and equity accounts go to the balance sheet statement. And then this cycle of the chart of accounts becomes the structure for everything that we're going to build to understand our business. So when we build the chart of accounts, we set it once, we lock it in, and we use it. We can change it at the end of the year if we want to like add some new accounts, or if there's an urgent need, then we reevaluate. But really what we want is all of our financials in the same format over time so that we can easily make comparisons and tell the story of our business, right? So if we make a budget that has one chart of accounts for the profit and loss, but then our analysis of historical data is in a different format, and then we think about how we might want to do it differently, and we do another version, and there's no way to compare these versions, right? So the chart of accounts becomes like the map or the baseline structure for all of the financials that we're going to build. And that speaks to your profit and loss, which also becomes the template for your annual budget, which also becomes the template for your monthly projections. So that list of accounts in column A is always, you want that to be steady, right? And then your balance sheet is the foundation for building your debt schedule, which is the list of all of the loans and borrowing that you've done and when funds are due. So usually, that's a monthly payment. And then the balance sheet and the debt schedule help us speak to cash flow. And that's where we can marry our monthly projections with information from the balance sheet so that we can really understand what cash we might have available or where the business might be experiencing a cash gap. If we can see a cash gap coming, we can borrow to get through the cash gap as long as we can see how we pay back on the other side, which is the whole point of building the monthly projections, the annual budget, and having a standard profit and loss statement structure that we're going to use for all those things. If we want to borrow to cover a cash gap, we really want to be a full financial quarter ahead of when we need it. I work on a very consistent basis with my clients to create 13-week rolling cash flow models. 13-week is a financial quarter, right? There are 4 of those in a year. If we can see that we are going to hit a wall with cash flow, then we can go look for funds to borrow or ask to increase a line of credit or whatever, where there's still plenty of time on the table to get that done. If we need cash in 2 weeks, it's going to be very hard to borrow unless we're very well connected within a network that supports us in our food systems work, because it kind of looks like you're irresponsible, right? Like you haven't projected out your business. You're not following along with your financials. You can't see this coming. Yes, stuff happens, right? Like maybe there's a horrible weather event and we lose crops. That's like a different story. But if in your regular operations of your business, you have a seasonality that requires you to borrow to cover the gap, you need to get ahead of it. And you need to be responsible with your reporting to those that you borrow from so that they trust you and that they're willing to lend you money. Okay, so quick review on chart of accounts, right? We at KTC recommend the 7-number system that we've created, where when you look at your profit and loss, the parent accounts are organized as such, as you see here. We have income, we have cost of goods sold, which are those direct costs that I mentioned with the coffee cup, the beans, the milk, the cup, the lid. And then we get our gross profit. Beneath the gross profit, which is our first measure of profitability, right? Income minus cost of goods sold. We have all these other categories of expenses. So we want to make sure all these categories of expenses are represented in the projections that we're creating to take to the lender. If you are missing operating expenses, or you don't have any representation of general and administrative expenses or fixed expenses, you're going to get a lot of questions and maybe some doubt cast on whether or not your financials are actually realistic or thought through. One-time expenses is an optional thing. We like to separate that because you might do something this year, like build a new website or invest in a marketing program that you're not doing again next year. So it just makes it easier to pull your past information and create a budget for next year. Okay, and then net profit is your income minus all of your expenses. That's the net profit. The first time you do this, and the first time you build it, it can feel a little bit intimidating. And I would just, this reminder here that perfection is the enemy of progress. Get it the best you can, as close as you can. And then if you're actually measuring your business performance over time against what you projected, then you will see what you're missing and you'll fine tune your process and you'll just get better and better at it over time. It's like any skill, any sport, any craft, you have to practice it. It's not necessarily intuitive. Just a touch on bookkeeping review, right? So in order to be able to create these financial statements, there's bookkeeping, housekeeping, best practices that need to take place in order for you to have current numbers that you can review and talk about. So when you think about what do I need to put on my checklist, this is really here for your review. You need a regular time to work on your financials on a weekly basis. Once a week, pick a day, pick a time, pick a favorite beverage, sit down and get it done, because otherwise transactions become too far away from our memory and we don't know what they were for and it gets confusing. You want to keep up with your sales and your payment entries on your systems always, right? We don't want to like come to the books and go, ooh, all of our transactions are sitting in Square and on our website and we've never entered them into our bookkeeping system and we don't really know what's going on. We want to categorize our expenses regularly. So that means like looking at your statements, what you've spent, looking at the receipts in your cash box, what you've spent, and making sure those are categorized according to your chart of accounts, right? Your list of categories. We want to record banking and credit card activities too. Paying your credit card statements does not appear on your profit and loss, right? That is a movement of cash out of your business, but those expenses were already booked when you swiped the credit card. Okay, so just thinking about all the things that need to happen to stay current. Looking at your cost of labor is a practice, right? Look at your wages, look at what you've been doing in the business and ask yourself if they're congruent. Reconciling your books every month, which is, you know, comparing your books to your bank statements and making sure all transactions have been captured and logged. And then closing out the month so that changes aren't made on past months. And then balance sheet transactions, right? We just mentioned that. Did you pay a loan? Do you have to split out the interest and the principal and ding the principal against your balance sheet and ding the interest against your P&L? Did you go buy a piece of equipment and take out a loan, and that financing and investing activity, the buying of the asset, the financing of the asset, needs to be added to the balance sheet, right? So, and if you did that right at the, like, let's say you went to like a dealership and you did that for a tractor or something, you're probably not going to see that ding your bank receipts anywhere because you just took out a loan right there. So technically the money came into your business and went right back out, but you've got to record that. And then reviewing your reports, look at the profit and loss balance sheet, statement of cash flows on a monthly basis, and, you know, take information from that as far as change from the prior month they're comparing to another period. Here's a list of the top reports that we generally pull from QuickBooks, just in case you do have QuickBooks, but you haven't quite gotten into utilizing your reports yet, right? We look at a profit and loss, we compare it against a prior period of time, we compare it against our budget, we look at our balance sheet, we look at our cash flow. There's 2 sales reports that are really helpful, sales by product and sales by customer. Looking at those regularly will tell you if you're properly entering your sales so that you're capturing at least categorical customer information and product information. The every item, every customer detail is probably not necessary, but you want that categorical information, right? Like I sold this much produce, this much dairy, whatever, or your customer groups like CSA, wholesale, you know, whatever they might be. And then looking at your receivables and payables aging. So how old are the funds that I need to go out and collect? How old are those invoices and the bills that I've entered but haven't paid yet? How are those aging out? Am I just like maintaining my cash flow on the backs of my vendors by not paying them, or am I actually doing okay? Okay, so quick review, and then we'll take questions and move into the next section. So I can give these answers or we can try to participate. If anybody wants to like give answers, just go ahead and shout them out. So what does the profit and loss tell us? What's the point of the profit and loss?
I'll go.
Drew, I see you, Drew.
Go, Drew.
It's the income and expenses over a period of time. So I would
Yes.
say it's showing you not a snapshot, but really a good look at your income and expenses for a given period of time.
Which drives out two key metrics, right? Our gross profit, gross margin, which is the percentage of sales that the gross profit is, and our net profit, right? How much is on the bottom? So what's that first line of profit, and then what's the bottom line profit? What are a couple things that the P&L doesn't tell us? I'll give you a hint. It's a 4-letter word. I know some people might be in the field listening to this or whatever, so I'll just keep going. But if I see you unmute, I'll pause. The profit and loss.
Alyssa put in the chat cash.
Cash. Oh, yeah. Let me open the chat on my other screen so I can see that. Thank you, Alyssa. Awesome. Yes, the profit and loss does not tell us cash, and it doesn't tell us any other financing and investing activities that are happening in our business. What do we achieve by reorganizing our chart of accounts? Debt. Another good answer, Daniela. Thank you. When we reorganize our chart of accounts, we achieve a template for comparison over time. And what makes our profit and loss accurate or not? Keeping up with our bookkeeping. Keeping up with our bookkeeping. Okay, so that's a profit and loss review, balance sheet review. Anyone want to, oh, I saw bookkeeping, thank you. Anyone want to throw in the chat or tell us what the balance sheet tells us? The balance sheet tells us a snapshot of business net worth. Thank you, Drew. Yeah, that's true. And I'll expand on that a little bit, that the balance sheet tells us what we own, what we owe, and what we've invested in the business, or what others have helped us invest in the business. Okay. So the difference between profit and cash, it's time most frequently, and then all of the transactions that don't appear on the profit and loss. Profit is income minus expenses. Cash is income minus expenses, plus and minus all the additional cash inflows and outflows of the business that aren't considered expenses or income. So it's like, well, what money could we be getting that isn't income, right? The capital from a loan, for example, or money coming in that we've already accounted for. So what is a useful companion document to the balance sheet? And I'll just mention, because I don't think I said this in the meeting yet today, is the debt schedule, right? So if you have a list of all the loans and monies that you've borrowed that you owe back to others and when all those payments are due, that's a really helpful companion document to the balance sheet. There is a balance sheet and a profit and loss in the shared folder that you can review. And then I just want to put here about minding the gap, right? So the monthly budget with cash flows helps us identify the tough months, and we want to see that ahead of time. So I'm going to minimize this, show a couple documents, and then take questions. We already saw the sample balance sheet. This has all of our assets, which in this case, for this business, small business, our bank accounts and places where we have cash. We have a petty cash box in the pickup truck. I don't advise doing that, by the way. It's very risky. And then we have a cash box that we use for the farmer's market that we keep cash reserves in so that we can make change. We have our checking account. We have accounts receivable. These are funds that we have invoiced for, but they're still owed to us. And then we have funds that haven't been deposited yet, right? So we've recorded the sale, but we haven't deposited those funds in the bank yet. We have liabilities. These are the things that we owe. So we have payable accounts, bills we've entered that we haven't paid yet. We have credit card bills that are due over time. And those are your current liabilities. Those are all the short-term things that are due. Then we have long-term liabilities, right? We have a couple of ag choice loans. We have a family loan. We have a CSA member loan. We have a tractor financing loan. These are long-term liabilities that make up your debt schedule. And then we have equity. So we have retained earnings, net income, and potentially some adjustments. So here's one example of a balance sheet. And then the other one that we really haven't talked about today yet is the statement of cash flows. So I'm going to show you that. bear with me as I navigate through our folders here for one moment. Okay, here is our.
Excuse me, Rebecca, folks are asking for you to zoom a little bit.
Sure, I will do that.
Thank you.
I have a really big screen, so sometimes I forget that I need to do that for you guys. Okay, so here's a statement of cash flows. Again, this like small farm example. It's pretty short, but I just want to walk through it. So what it shows us is for a particular period of time that we've selected, what's the net income? So this is straight from the profit and loss. Comes over here. Then what are the adjustments to reconcile a net income to net cash? By operations activities, investing activities, and financing activities. Those are the three pieces of the statement of cash flow. So we can see like, oh, we have accounts receivable, like we invoice these funds, but they haven't actually been paid yet. So that's going to make our net profit and our net cash different by $7,000. We also have accounts payable. We also have credit card payments that went out that, you know, aren't going to appear as expenses because they were expensed a long time ago. So we have these adjustments, right, which take our net cash from operating activities from $60,000 net profit down by $12,000. Then we have investing activities. We purchase an asset, so that's $25,000 out the door. But then you can see the matching. We have a new asset loan, so that was $25,000 in the door. In future months, we'll see payments on those loans, but this particular month with a brand new loan, we don't see that. And then we see the other financing activities. And that matches, if you remember the balance sheet we just looked at, the loans that we saw on the balance sheet. Then our net cash for the period is going to change by these amounts, right? So we have our profit from our P&L, and then we have changes to that based on other cash outflows that give us a net cash from operations. Then we have financing activities, and then we have our investing or lender-related activities. If you're buying like securities and stocks and stuff, like that would go in here too, but that's generally big business stuff. So I'm not going to talk about that today. So then we have a change in cash for the period. At the beginning of the period, we have $3,452 in cash. At the end of the period, we have $6,000 and change. This cash at the beginning of the period is going to be something that will not be accurate unless your books are reconciled. So we need to like keep the books accurate and close them at the end of each month so that these reports can be accurate moving forward. This is here for your further review. You guys are welcome to email me some questions if you have them, or just keep this for reference. And again, here's the balance sheet with those same loans listed here and their total amounts. So we're going to move on in just a second to talking about lender readiness, but I want to pause and be able to take questions, and I will take a look at the chat. I don't see anything new in the chat, but if we do have questions about some of these basics, let's take a couple minutes and talk about it, because this is definitely the foundation of being able to understand like the lender's needs.
Yeah, and I sent out the recording of the full day like financial literacy in-depth workshop that Rebecca provided on the end of August. So it might be a bit hard to follow because it's in person and the recording is not as friendly for just watching later if you haven't attended. But there you can also find a lot of what she covered very quickly here, but much more in depth.
Thank you, Hannah. And I think also, even if the recording might be a little harder to follow, given that we were in a live environment, the slide decks have a lot more information. And in that folder, there's more samples and things to kind of take in and build your knowledge base.
Thank you. Mm-hmm.
Yeah, absolutely. Okay. And if we have, so I went through that, like, I think as efficiently as we can, given the amount of information. And I think I expected more questions. So if we have time at the end, we can take a little bit of a deeper dive through those financial statements, if that is something that will be helpful to folks. Okay. Actually, there is one more thing I want to show before I move on, because again, I was concerned about having enough time for questions. So what I'd like to do is go back to this example of the small farm profit and loss, because really, like, the profit and loss is the key financial statement that we want to understand to be able to talk about the profitability and tell the story of our business, right? This is the first one that we're going to really dive into. So as we said about the chart of accounts and the parent categories, right? We have our income section, we have a cost of goods sold section, and then we get gross profit, which is our first measure of profitability. We can see this percent. It's a percent of sales, and that is gross margin. So what we have left after our direct one-to-one expenses, again, like you can see examples here, or you can think about the coffee cup. That means that we have 73% of our income left at the end of 2021 to cover the rest of these expenses. And why might this change from year to year? Well, we might not get the income that we expected. We might spend more in a certain area because of something that we're doing in our business that's different. As you can see from this profit and loss, just talking about how the profit and loss helps tell the story of the business, they did a lot more resale of other items in 2021, and that turned out to not be quite as profitable as just growing and selling our own stuff. But it also helped to increase sales and, you know, give customers more satisfaction with their ordering. So these things have to sort of be weighed back and forth, right? Are we losing anything by this drop in gross margin? The gross profit, the dollars itself went up. So we need to like talk about how that impacts the story of our business. We have labor, right? Salaries and wages, payroll taxes, workers' compensation, insurance. We can see the difference of how those numbers play with sales as the business grows. And you might say, like, jumping from 23% up to these big percentages, like, what happened here? Did we just grow sales and need more labor? Or was there something else that was going on? And in this particular case, there's a story behind it, right? Like the owner had to step away from full-time with a new baby. And so there was definitely more labor brought on and would stay on moving forward. So it changes the whole ratio of the whole like pie chart of the ratios of the business. We have operating expenses. We have general and admin expenses. And if you don't have a chart of accounts yet, you know, this is a great example to use to help build yours. We have fixed expenses, insurance, utilities, but, you know, this person doesn't have like an expensive land here in their fixed expenses, which is kind of an outlier situation. We have one-time expenses, and then we get the net operating income. The rest of the P&L, the other income and other expenses, it's going to be a little more discretionary. Those are the things that aren't directly tied to the operations of your business. But what I wanted to be able to show you is that we can use, so this is collapsed, by the way. So if we look at the version that we were looking at and we start to close these sections, we end up just looking at the parent accounts. So if we go to this version where we were just looking at these 7 numbers, income, COGS, the 4 major categories here. This one doesn't have the one-time expenses in it. And we build a budget, or we're looking forward. What we can do is wrap the statement of cash flows in an abbreviated form into the bottom of the profit and loss. Because this farm's business model is relatively simple, and they're not doing receivables and payables at this point in time, all we're really looking at here at the bottom and the cash that wouldn't be on the profit and loss is the debt service. So what are they paying in credit card payments and loans? So in this particular case, if we can start with the beginning balance from the checking account, assuming there's only one, if there's more, you have to combine them. And then we get to the net income, and then we take away the debt service. Where do we land? So what we usually need to do is put a beginning balance in somewhere. And so I'm sorry, I didn't scroll down enough. You probably couldn't see this. We have the beginning balance, the net profit, the debt service, and the ending cash balance. So what that does is it takes what's in the checking account, adds in the profit that's left at the end of the period, takes away all the outflows, the debt service, the credit card payments, and then gives us a forecasted ending cash, right? Because this is future focused. We don't know if this is what's really going to happen. We have to hit all of our goals around revenue and expenses to get here. What we do know is we owe that debt service no matter what. So then we can take the ending balance, make it the beginning balance for the next period, and then follow the same cycle. And if we see the ending cash balance growing over time, that's telling us that the business is growing in value. It's also telling us that we should have enough cash to cover our operations, but we would really need to get into a monthly forecast in order to do that. So when I say in our presentation, like mind the gap, where is the cash gap? Sometimes, like let's say this beginning checking balance was only $2,000. Then once we have profit and debt service, we're in a negative cash situation. Now we need to really dig into the monthlies and figure out where the cash gap is going to occur and how we're going to borrow to get past it. Because it looks like the next year, we're actually going to be a positive ending cash and then continue to move forward. So beginning balances and off profit and loss transactions for movement of cash are really important in understanding your survivability as a business. If you don't have cash, if you have no liquidity, how are you going to buy your supplies? How are you going to pay your people? How are you going to keep going? So if we're just looking at the profit and loss in a vacuum, it can be a dangerous situation. So that's what I want to illustrate here. And if there's any questions about that, I'll take them now and then we'll move on. Okay. Thank you for listening. These are the kinds of things I'm going to be passionate about explaining to you because they're really important in making sure that your business is viable and can continue. We want to see your farm and food businesses profitable for good, right? So we have to go through these things to understand how to get there. All right, let's begin our discussion on lender readiness, section 2. My business needs money. Now what? This happens with farms. This happens with food manufacturing. This happens with businesses that move food, right? Like distributors and hubs, and also those that serve food. Every business may have periods of time where line of credit is necessary to, again, bridge that gap. All right, so beginning to discuss borrowing preparations. Who are you talking to? What is the scale of your business? For the most part, from those of you that I know in the room already, and I don't know all of you though, generally this is like a small business audience, right? We're probably somewhere in the realm of like under $250,000 in sales at this point in time, and sort of like that $250,000 revenue point. $250,000 is sort of where I see a difference in the ways that people are borrowing money. But at the small business scale that we're all familiar with in small food manufacturing and farming, generally speaking, your first line of asking is friends and family. And that could be asking for a loan, or it could be asking for an investment, right, for equity. So what are they getting in return for that investment is an important thing to figure out. Not just say like, oh, now you're an owner, and what does that actually mean? So that's the first, usually like the first ask. The next one that comes after that is often crowdfunding. So can we do some kind of a Kickstarter campaign or, any other platform where we're asking, again, friends and family, but also expanding the circle if they're interested in funding the business. A lot of times with crowdfunding, we're not paying it back. Sometimes we're giving something in exchange, like a t-shirt, and we need to think about the investment that's required to go raise those funds. But that is another really great way to get started. There are also crowdfunding platforms specifically for small businesses that go beyond your social network. And the one that I'm thinking of right now is Kiva. And the first round of funds with Kiva is $10,000. And if you graduate and you pay it back, then you're able to go access another round of funds. The third one is prepayments. If you run a CSA, you are borrowing money. If you're still using the old school format of like you pay up front at the beginning of the season. So thinking about prepayments, right? If we're in a situation where we need cash, can we ask our customers to pay in advance for certain things or develop prepayment programs, right? That might be all you need to cover the gap that you're looking at. We also have seller financing. This is just a fancy way of saying like, I'm going to Home Depot and I'm going to take out a Home Depot credit card to buy the hardware that I need to build this shed. Or I'm going to the tractor dealership and I'm going to use their financing, or a pickup truck and use the dealer financing, etc. All of these things are fairly easy to do without necessarily having the sophistication of financial statements that you would need to go to one of these other lending types. However, I will say that if you want to be responsible to paying it back and to the folks that are lending it to you, you still should have your projections sorted out and understand how and when you're going to pay that back. The last three options here are a little bit more traditional, right? The first is a micro lender. There are definitely some folks down in San Diego County that are doing small business loans. Usually micro loans are for like $10,000 or less. Some financial institutions might say, that number is higher. The next one is a mission-driven lender. So this is not a typical bank, but this is an organization that is focused on the work that you're doing, right? Sustainable food systems or something of that nature. And so they're looking for small businesses that they can support, that they want to invest in. And they generally do a lot of lending based on character. Like, you still need to have your financial statements in order and show that you know exactly how and when you're going to pay those funds back. But you need to make a pretty strong and confident case for your business. And you probably need to have some decent personal financial history. But they exist specifically to fund businesses and organizations that are in our space, that are in the sustainable food systems. So they want to hear that story and they understand that story. I think then the last one is going to be conventional loans, right? So depending on whether or not you're a farm business or not a farm business, right? Maybe you make jam. You could go to FSA or the SBA through a bank and potentially borrow funds that way. Those loans are going to require a little bit more of a rigorous review process, due diligence. And so all of the information that we talked about with the financial statements is really going to be important. Does anyone else in the room have any other types of lenders that they've borrowed from in their small business?
Well, folks might answer to that question, Rebecca. There's a couple in the chat that I think we could try to address now, and maybe also Sona can help if I'm trying to remember the name of some in San Diego.
Yeah, I know that Accion does microloans in San Diego. I mean, literally you could Google like small business microloans and in San Diego and find a number of organizations that are doing it. I think in the mission driven too, sometimes CDFIs can fall into that space too. So if you're thinking about like needing a bridge loan for your farm to get through a seasonal swing, FarmLink is another really good resource to go talk to. So I would start with those two.
Yeah, and I think to the second question of where does USDA fit into this, is it correct? That would be the conventional loan. Like FSA is under USDA, right, Rebecca?
I believe FSA loans are under the USDA. And there's also like rural development programs and other things like that, but not sure that that's necessarily applicable to, depends where you're located.
Yes. And then Sona shared a resource in the chat.
I know, I'm grabbing one more too. Just read more and start here. I think when we talk about loans, one of the things that we don't really talk about is grants, which are funds that don't necessarily need to be paid back and that are really great venture capital for farms. And I think, obviously two of the biggest grant situations that are available for us, like the USDA is really the largest venture capital funder for farms in the country. There's a number of different grant programs that you may or may not be eligible for. CDFA has grant programs that you could potentially be eligible for. And then specifically NRCS, if you're looking for programs around like building a high tunnel or improving your irrigation, it's important to understand what's already out there for you with grant funds that will help you bridge a gap. Usually grant funds are meant for something really specific and very frequently aren't eligible for purchases of assets. Like most often they're meant to be working capital to grow your business, with the exception of those NRCS programs that are driven around like conservation practices where you can actually purchase assets. So if you need equipment for your business that's growing, or you need to bridge that cash gap in a seasonal cycle, you're going to want to go to a lender, not necessarily like go through a maybe process where you might win a grant that takes a long time. So those are more like long-term scaling strategies.
Right. And also we at with the local food economy lab are preparing now. Oh, there she is. Someone saying that the same thing as well. So we will be launching in the next couple of months, and in a few months, a digital resource hub is what we're calling, with lists of grants and loan possibilities and such. So we're hoping that will be very helpful for.
That's amazing.
Yeah.
That's such a great resource, you guys. So keep your eye out for when there's like an email release of that directory. That's going to be so helpful for everyone in like vetting through that process. Because like I said, if you're just Googling microloans in San Diego County, you're gonna have to do some homework before you can figure out what to do with what you found in your, first wave of primary research. Okay, so we talked about borrowing preparations, who you're talking to. The next piece is what's the basis and risk situation. So lenders need to evaluate applications based on risk, right? So how they do that is by personal character references, conversations about the business, potentially looking at your personal credit history. It's important for you all to understand, and I think I mentioned this already, that we have a responsibility to report the business's financial status, the good, the bad, and the ugly, to those that we owe money to. So if there's a bad situation in the business, by no means should you cover it up. You should talk about it early and honestly, and then work together on solutions that get you past that point. They want to get paid back too, right? So, it's a partner in your business strategy. And that raises the question, are you equipped to be able to report out? So like we talked about, do you have QuickBooks? Do you have a spreadsheet? What are you doing? Is it professional? Can you count on it to be accurate? Just pulling your bank statements and your tax returns, while like some lenders may accept that for very small businesses, isn't a responsible practice. You might find yourself in a big pickle if you go that route, because you don't know how and when you're paying those funds back. You don't know what your future cash flow looks like. Okay, what and why, right? So we're preparing to ask the lender, how much do you need? You probably know what you want to purchase to scale up. You will, at that point, if you're borrowing to cover a cash gap, will know how long and how much you need to get there and what the risk is. So if your projections are super optimistic, you might need to tone them down a little bit to give yourself a little bit more wiggle room in case you don't meet these like scaling up sales projections that you were thinking about. You need to know when you can pay it back, and you need to be able to explain to someone why they should invest in you. So the financials and the projections and the cash flow is what's going to tell the story of why they should invest in you and build the confidence that they can understand how and when you can pay those funds back. So when you're like, okay, I'm going to go pitch for a loan or for funds, what do I actually need? Like, what's my punch list here? And so one of the things that you're going to need is some kind of a document that explains your business. So is that a business plan? Maybe. We have a format that we use at KTC called the one-page strategic plan. And at the scale of the majority of the businesses that are in this call today, the one-page strategic plan is going to be enough. And I'm going to show you what that looks like. There's a template for it in the shared folder. As you know, a business plan is like a full-blown narrative document that can be 50, 60, 100 pages. It goes through all of the information about the background of your business, the operations, the marketing, the finance, and then has all the financial pro formas. It is a ton of work, requires a lot of time. Those of you who are working with us through the Local Food Economies Lab are building a high-level abbreviated business plan with us. And a strategic plan is just one step back from a high-level business plan. So this is a guiding document if you need to put something together fairly quickly and you don't have the time and the resources to go through a business planning process and develop that larger scale document. One-page strategic business plan will cover the basics of your business. What are your core values? So that mission-driven piece. What is your purpose? What are the things that you're extremely good at doing? What are your core competencies? What value do you bring to the world? And then what is your market niche? Who are you targeting in your business? Then we go through SWOT. SWOT is just an abbreviation for the 4 words you see across here: strengths and weaknesses, opportunities and threats. Strengths and weaknesses are internal. These are the things that apply to the skill set of your business. Opportunities and threats are the pieces outside of our control. So opportunity could be like this new grant program that the USDA is opening up, as a made up example. A threat could be like new regulations that are coming down the pike, or a new competitor that's opening in your region, right? As opposed to weaknesses are, we don't have good financial controls in our business, right? So you want to fill those out, top 3. You can always expand this if you want to go more than top 3. And then we have targets and priorities. So for every year or every period that we have on here, right? We have this year, the next financial quarter, and then long-term 5 years. What's our sales goal? How many employees? How many customers? Profit goal? What is our debt going to look like? And what are our key financial metrics, the top 3 that we're watching? Those key metrics are going to be the next section of our presentation. And that helps us understand how to tell the story of our business even more, and what's important and crucial to our success. Then we can also list like the soft priorities, like our objectives, our action steps beneath each of those to achieve. And then at the bottom, we have a sandbox. These are the things we're thinking about for long-term, or some other things we want to work on that have come up in the strategic planning process. I truly believe that if you have some financial history in your business that you can review, you can sit down with a business partner, mentor, trusted advisor, peer. Probably not great to do it alone, and work through a document like this in like 2 to 3 hours, right? Because you need to identify financial points in here. So you would need your financials already ready. So we'll look at a sample that's filled out. Again, you can review this in more time on your own. But here's an example from a small firm that I worked with that agreed to allow us to share this today. So I'm really grateful for their generosity to share this template, because I think it makes so much more sense when it's filled out. So we can see their core values, right? Providing organic products, amplifying the values that the local farm implies, and safety. Their purpose, their core competencies are around quality, flexibility, community, a niche in honey production. And then their market niche talks a little bit about what they do. This is a farm from a different region, so they have Christmas trees, which is, definitely a specialized market niche. And then SWOT, we can see what are their strengths and weaknesses, and then what in the environment around them is going to be challenging. And then I think the part I really want to focus on with you is the financial targets and the relative priorities. Thank you, Daniela, for the comment. So we can see their first year target or sales of $78,000. Just for the next financial quarter is $18,000. And then their 5-year targets. And this is based on a financial model that we built off of their profit and loss that also incorporated cash flows at the bottom. Yes, I can zoom in more. Tell me if it needs to be more, but I want us to be able to hopefully see enough of it together. So who are the employees, right? At this point, we have a part-time market worker and the owner. And then 5 years from now, there's a couple of part-time field hands and then the 2 owners with this type of a sales goal. That might seem short on the labor supply, and we had a number of discussions about it. So we want to identify customers, right? And this is really not like my customer is Daniela and Jorge and Susan, right? This is, I need 40 customers per week at the farmer's market with an average order value of a certain dollar amount, and 40 per week at my farm pickup for the season. And then I'm taking on a new market where I need 65 transactions a week, and then this much in CSA sales. My farmer's market sales average order value is projected at $10. That is a low farmer's market average order value, but based on their geography, that was what they felt was appropriate. So, and then in the next quarter target, you can see we need a major wholesale customer, and then we have those other metrics. And then 5 years from now, we don't know what our averages are going to look like at this point. So we just mentioned that we're looking for this percentage increase and a rough idea of how many customers per market. and then moving forward in some of their value added production and the types of sales that they're looking for. Okay. Then we have profit goals. We had some, remember, this one's just a quarter, so it always looks smaller. Now, I will say this is a really interesting situation, because if we look at what the net profit is after sales, it seems really high. And this is definitely a situation where there wasn't a land payment. There was like a family land ownership situation. They had practically no overhead. It was an outlier, right? Like, I would not expect a business doing $80,000 a year in sales to retain 50% net profit. But sometimes when businesses are very small and they're leaning on resources of either their personal lives or their family lives, and those aren't actually financially accounted for, which is not the way I would really advise doing it, profit looks inflated. What they probably should have done was have the family develop a scenario where, you know, they were paying that overhead and utility expenses and expense of the farm. But at this really small scale, again, we're just like looking at survivability at this point. But as far as like best practices for what's going to work best for your taxes, and also representing like the true cost of doing business, it's not all in there. And so that may also be your scenario. And you may also need to tell that story when you are interfacing with a lender and they're like, well, why is your profit margin so high? That's not realistic. And it's like, well, actually, I'm on my aunt's land and she doesn't charge me anything for it. And she doesn't charge me anything for the water either. And we've been promised that this will continue indefinitely for the next 5 years. And actually have a letter of intent that she signed. You know, I mean, you may need to go there, because you can't depend on helpful situations outside of your business to be consistent. And if that's how you're going to pay the lender back, then you may need like proof of the continuance of that situation. Okay, then we're showing debt and we're showing key metrics. So I want to talk about key metrics: weekly sales, average customer order value, and operating expenses as a percent of sales. Because at this scale, we need to make sure our operating expenses don't blow up as the sales are growing. We need to make sure that we're hitting our customer order value averages, or we need to rethink how we get more customers into the customer funnel. Because if, let's say, our average sale at the market is 6, not 10, we need so much more customers now to meet that sales goal, right? So putting this together is really informative and helps tell the story of your business. The metrics for just the next quarter might be way more specific. And in this case, because of the way that we want to build more customers at the market, these are some really marketing focused metrics. And then as we grow to a much larger scale, we're really going to start looking at labor, cost of goods sold, those major categories of the profit and loss against sales. And then how are we going to hit these goals, right? We have these priorities. So for the next quarter, there's a lot of goals around specific marketing programs, hiring a part-time person, figuring out how they're going to manage that cash gap, getting those projections together and getting out and either deciding to open a line of credit or take out a small micro loan, and then actually getting signed up and into one more farmers market that's going to help them scale up, right? So this is a tool that I think all of you should be able to utilize. And if you have your financial history together, looking at these targets and then taking the steps to build some forecasts for the next few years, it's a process. Like, I'm making it sound a lot easier than it is, but these are the tools that you're going to need to be able to go out and not only just borrow money, but understand how and when you can pay it back. And again, if you're just borrowing, I don't mean just, if you're borrowing $5,000 from your aunt to invest in the next growing cycle and she doesn't need to be paid back, that's a very different story than if like she's really trusting you and she's on a fixed income and she does need to be paid back and this is the payback schedule. How are you going to achieve that? And as a responsible individual, like, these are the tools that you will need to forecast that out, understand what's going to make or break it, and keep yourself focused and accountable on certain targets and goals, right? Because if we didn't actually say this stuff in the priorities for Q2, but we did say that, you know, we need X amount of new farmers market customers each week to be able to hit our sales goal, but we didn't actually lay out how we were going to get there. And we just kept on like working in the business instead of working on the business, then we probably won't hit those goals. It's not just going to magically happen. So we need to understand what's driving the outcomes that we're seeking. All right, so I'm going to close this for now. Go back to the presentation. We did already look at the budget template. We went through that with eSpend Farm. And so those two documents go together, right? You build that budget with the cash flow at the bottom, and then you build out your strategic plan that supports those goals. And there's a little bit of back and forth, right? Well, maybe this isn't actually a fit. Back to the drawing board and back ahead again. I think there was a question.
No, I was gonna ask if you needed a break, anyone needed a 3-minute break. But I think we're in good flow here, right?
Yeah, I'm doing okay. Thank you. Okay, so we have the strategic plan or the business plan. If you have that, that's great. That's like more in depth. Then we have the pro forma. You probably hear this word a lot, and it's like, what is that? Pro forma just means like in a standard form. So people say pro formas, it's a synonym for budget. It's a synonym for financial projections, just in the form of a standard profit and loss and balance sheet with cash flow. So when we say the lender will need a pro forma package, that is either the business plan or the strategic plan and the financial statements, right? It could be the profit and loss with the forward budget, with the cash flow at the bottom, and a current balance sheet to support that, right? That would probably be enough at the scale that you're at. And that's what it means by pro forma. You could do a whole separate statement of cash flows, but if it's really simple, like the farm that I showed you before, you can probably just combine it the way that I showed in that example and would be sufficient. And then the balance sheet is like the backup for the net worth of the business. Okay, and then so once you can see all that, you need to formulate the ask. What do I need? Well, I'm looking for a $40,000 loan that I can start paying back 9 months from now. I'm looking for a $10,000 loan that I can start paying back in January, right? You need to understand what you're asking for. And I'm using that for working capital to bridge the cash gap in a seasonal business. Or I'm using that because I'm scaling up and I need to buy materials to build a storage shed and finance like this value-added equipment to be able to do my hot pack on my jams, right? You need to be able to formulate what you're asking for, what you need those funds for, and then be able to project when and how you're going to pay it back. I think we covered all that pretty well at this point. So here's your punch list for your pro forma. If you have financial history, if you're not a brand new business, your historical profit and loss, your historical balance sheet, right? So maybe it's like the profit and loss for last year and the balance sheet from the end of last month, last time we reconciled. Your debt schedule, your grant schedule, right? Because that's going to impact the cash that you have, and maybe some of that's for working capital or whatever. Your production and inventory cycle if applicable. So like, let's say you're making nut butters and you buy all of this raw material, packaging, whatever, and then you make your product and then you sell that product over a 3-month cycle, right? So they're going to want to understand your production and inventory cycle as well. How much cash are we spending up front? And then how long are we taking to sell off those goods? If you're making a whole year's worth of goods right now, unless like what you're doing is hyper seasonal, right? That's not going to be the best use of cash. You're going to want to like potentially spread that out. Sales projections by channel. So like CSA, farmers market, whatever your channels are, or by major customer. Let's say you do all wholesale, right? So it's like this school district and this specialty grocer, whatever they are. A labor chart. So if you're paying hired labor to be able to express who is working for you and at what scale. And then you may need cost by product information, right? If you make 5 different things and they all have different cost of goods sold structures, and you're projecting a sales increase and they all have different margins, which ones are you projecting an increase by how much? And then how does that impact the gross profit, right? If we just say like, we're increasing sales by 20%, all products equally, that's realistic, great. If it's not, we're gonna need to do a little bit more work to understand how we get there. Okay, got it, now what? Now it's time to do some serious work, heavy lifting if we're gonna go out and ask for some money. So we need to build a budget for the next 3 or 5 years, 3 to 5 years, depending on like the scale of the program you're working on. I want to just clarify that budgeting is synonymous with educated guessing. Like budgeting sounds so fancy and complicated. It's understanding line by line what's going on in your profit and loss statement, for example. How is that going to be different next year and why? And then taking a guess. Sometimes those guesses look like a 10% increase or a decrease of $10,000 because I'm not going to use that part-time person anymore. I'm going to do it myself, etc. So we start with sales and then go through the other categories that we discussed: COGS, labor, expenses, which lumps together operating, general, and administrative, and fixed, and one time. And then you can add that cash flow section: loans coming in, grants coming in, assets being purchased, loans being paid, etc. So this is your punch list. This is an example of what some of those more detailed items might look like, right? Like we talked about sales projections and labor charts. This is here for you in the slide deck if you want to come back to it, just showing, here's a simple chart of my major sales channels and my projected sales. And here's a chart of my workers, what I pay them per. I'm sorry, this is really old in a different state because these numbers don't work anymore. And then how many hours they're working and what that looks like in a monthly total, right? So this is a simple way to forecast those couple of items where you might need more detail. Why these two and not everything else? Well, these are usually the two biggest numbers on your profit and loss: your sales and your labor. So, okay, got it. Now what? Does it pencil out? Can you pay the loan back? When you run the projections, does it look good? And then you want to ground it with written assumptions, metrics, and ratios. So when I talk about assumptions, metrics, and ratios, right? Like if I go back to my small farm profit and loss. Oh no. Okay. And I look at, operating expenses, for example. What are the assumptions I'm making? Well, in my financial history,
can you zoom in a little bit, please?
Yes, I'm just going to give like one example. So in my financial history, I had 8% of sales on small tools and equipment. That seemed like a lot. We're pretty well stocked up on everything we need. I'm going to reduce that by 3% and control it by watching my expenses month to month. I'm also gonna tell my staff that has a credit card that they're not allowed to purchase small tools and equipment without my approval, right? So what's the assumption behind how we're going to make a change? And that's what I mean by assumptions, metrics, ratios. We're going to talk about metrics and ratios next. So looking at that sample budget with cash flow is going to be, sorry, I'm pulling it back up one more time. I think this is a key document for all of you. If you don't have this yet, this shows you how to set it up, how you might run it, how you could follow through with formulas. And again, when you get to the budget piece, how to incorporate beginning and ending cash in with your program. Now, I realize this is like a 2-hour webinar, so that's as deep as we're going to go into it right now. But I do encourage you guys to take a look at this stuff on your own and follow up with questions. Just another word about cash flow. I talked about this in the literacy training also. There are literally only 8 ways to increase cash in a business. And it's right here. So I need cash. How am I going to do that? You can refer to this list. I can increase my cash sales, right? Not sales on invoices, like sales where I get money now. I can increase my gross margin. So that means controlling my cost of goods sold. So maybe if I'm making the coffee cup, I want to source different lids that might be less costly, for example. You can decrease your cash expenses. So that means like the small tools and equipment, the operating expenses, all of the things that are kind of happening below the gross margin line, we can turn those down. We can increase our payables balance, which means not paying our bills, which is only a good solution very temporarily. We can decrease our receivables balance. So that means like calling people and saying, you have an outstanding invoice, can you pay it now? Or it means we were offering 30-day terms. Let's talk to all of our people and maybe offer 15-day terms. Or maybe we just don't offer terms next month and we talk to our best customers and they understand that we're in a situation they want to help us out. We can sell assets, what's sitting in the shed. We can increase liabilities. So that means taking out a new loan. And we can increase equity in investments, right? We can ask people to invest in our business, but what are we giving away for that is an important other piece of that equation. All right, so that is the end of the lender readiness section. And we're going to move into our final section on business performance and talking about ratios and storytelling. I'm just going to pause for a second, see if there's questions. Okay, we'll go on. Feel free to type questions in the chat. I have it open on my other screen. Okay, business performance. This is an introduction to ratio analysis. Again, don't get intimidated by the terms. It's just fractions. One number divided by another. Telling the financial story of your business. This is a quote from one of the early authors in human resources management and general management. And this is just what gets measured gets managed, right? If we don't have an idea of how we're doing in any given area, it makes it pretty hard to put management practices in place. Ratio analysis, what is it and why? Financial ratios show the difference between numbers, show the relationship between numbers. So we've already talked about one financial ratio a bunch of times today, which is net profit, which is the bottom line profit divided by, or your sale divided by your sales, and then you get that percentage. Right? So if I have $10,000 in net profit and $100,000 in sales, I have a 10% profit margin. And a lot of times that word margin just means as a percent. We have a go-to list of key financial ratios for financial management in the lender readiness webinar folder. It's making me sign back in on my other screen. Hold on a second, guys. We have a key metrics worksheet. I'm just going to drag it over for a second. We're not going to just go over it just yet, but this is a list of the metrics. So what is the name of the calculation? How do we get there? And so we'll talk about these in a second. These are going to be the most important ones for lender readiness. And the metrics that align most closely with the strategic goals and the performance of your business are often called KPIs, right? Maybe you've heard that. It stands for key performance indicators. What's the difference between a financial ratio and a key performance indicator? The only difference is that the key performance indicator has been identified as a very important ratio for you. So key performance indicators often are financial ratios. It's just like a slim selection of the ones that are most important to your business. Somebody wrote gold in the chat, and I think that's in reference to the key metrics worksheet, and thank you, and you're welcome. Okay, so going a little bit deeper into your ratio analysis, a couple of things to keep in mind. Your fixed costs, because we often talk about ratios in the profit and loss, right? So we want them to be consistent over time. Like if we're 150,000 in sales this year, we're going to be 175 next year. We don't want to see our labor go from 30% of sales to 40% of sales. We want to see it stay relatively consistent. So where are some of the areas where that might be different? As you scale up, you want to see your fixed costs trend down or level out, right? So if I'm growing more and selling more off of the same amount of land, right, those fixed costs as a trend should go down a bit. If I'm scaling up and moving into a bigger manufacturing facility for my jams, I'm going to see an increase in costs, in fixed costs, and then hopefully see that trend back down as I scale up more. Your variable costs, the things that are directly related to how much you sell, your cost of goods sold, your operating expenses, your direct labor, should trend fairly steady, unless you make a major process change in your business, right? Like, oh, we just outfitted this whole new wash and pack room. And so with that, we're going to see more efficiency. And then therefore we want to see our labor trending down because we made this investment for the purpose of labor trending down. Then we can explain it. And we don't just go to a lender showing 3 years of financials and they go, why does your labor go from 40% of sales to 35% of sales in these 2 years? What's going to trigger that 5% decrease? You have an answer. Trends expose the opportunity to improve, identify what questions we can ask, show us the key focus areas in our business, and where we're efficient or lacking efficiency. Okay, Looking at business performance through ratio analysis and comparison over time will help you become a financial storyteller for your business. So I just want to share that with you because it's really important to be able to talk about it and tell your story. So looking at those ratios, comparing them over time, that's what's going to make you confident and competent in going out and talking about the financial sides of your business. So these are some of our key business performance ratios. And I'll go back to the metric sheet in a second, but sales per employee, right? Like if we're scaling up our headcount, what does that look like in a sales per employee lens, right? Are we purposefully taking a step down in efficiency and productivity, or are we just really scaling up? What's labor look like as a percent of sales? What's gross margin? We talked about that. That's your gross profit as a percent of sales. Again, margin often usually just means percent of sales. If you are producing like hard goods for resale, right? Like if I guess hard goods is the right term. If you're producing non-perishable goods that are going to sell, that you're going to keep in inventory, like nut butter or jam or, jarred preserved products or boxed products or whatever, what's your inventory cycle? How many times is your inventory going to turn in a period of time, usually in a month, right? What's your average pay per employee? This is a longevity metric, right? Like, are we giving people a viable lifestyle where we can keep our employees, or are we just going to experience endless churn? Are we taking care of our people? What are our dollar of sales per dollar of assets, right? So like, I want to go buy this thing. It's $50,000. What's that going to look like a couple of years from now in dollar of sales per dollar of assets? Is this thing really going to be worth the squeeze? And then here's how we are going to calculate those equations here on the right, on the opposite side. I'm curious what other performance metrics you may have found valuable or maybe using, and feel free to type those in the chat and I'll circle back if I see some responses in there. Some key ratios for lender inquiry, right? These are like, how are we doing as a business? And then these are like, what is the lender really going to want to see in addition to that? And so these metrics, I've identified 6 here. There could be more. Net profit margin, right? This is how's our P&L performing? Income and expenses, how's it performing? Is it positive? Is it growing? If it's consistently negative, we have a problem, right? We know that. Same with gross margin. This is the first measure of profitability. When we produce our goods, how much is left to cover the rest of the expenses in the business? I once had a business come to me out of a accelerator program for food businesses. They had a concept for this like amazing beverage that was made out of aloe and a number of other things. It was super cool. They won a contest around like beverage innovation. And then they brought their model to me. Their cost of goods sold left them with a gross margin of 3%. If you think about the scale of sales that would be required, where after your direct cost of goods, especially in like a CPG environment, consumer packaged goods environment, where 3% of sales would be enough to cover operating expenses, fixed expenses, labor, general administrative expenses, which include the marketing campaign, right? And any one-time expenses necessary for scale up. That's not the kind of gross margin that a lender is going to feel confident about. Okay, so the gross margin is going to tell you, like, where does my profitability problem live? Is it in the direct cost of producing the goods, or is it in the way that I'm managing the rest of the expenses of the business? Or is my price just not appropriate? That's going to be that cost of goods sold piece. Gross margin. Current ratio is an important one that lenders like to look at. Current ratio tells you your ability to pay off your debts from a short-term perspective. So it's current assets, which is like basically cash in the bank, the petty cash, things like that, over your current liabilities. So the things that you owe now, receivables and payables would be in there too. So it's like a liquidity assessment. They're going to be interested in burn rate, which is a term for, and these are all defined in the handout as well. Burn rate is the rate at which your company is using its cash. And this is something that we look at when we're in an early stage and we're not generating profit yet. So like, I planted my first crop and I'm not going to have my first CSA sales for 6 months, and I'm just doing land prep right now. How much cash am I burning every single month? That's my total monthly operating costs. That's my burn rate. And so then that leads to runway. Runway is the total amount of capital that you have over your burn rate. So like, for example, let's say you need $5,000 a month to just like keep going until you get to that sales cycle place. If you have $25,000 in the bank right now, your runway is 5 months, right? The total capital, 25,000 over the burn rate, which is $5,000 a month. And then also dollar of sales per dollar of debt is an interesting metric that can help you understand the relationship between your sales potential and your liabilities, or what you owe. Okay, before we review this, I'm going to bring over the key metrics worksheet. Okay. KPIs are, a lot of KPIs are just numbers from your P&L or balance sheet, right? So sometimes your key performance indicator for your business is like monthly sales to date, right? And that's just a number. And even though it's a key performance indicator, you might not have to calculate anything. Some high level numbers to check often for your financial performance include your sales by enterprise, right? So like, let's say you're doing multiple things. What are my produce sales? What are my agritourism sales? What are my egg sales, right? Checking into each way that you generate money for your farm or your business. Gross profit, which we already talked about, which is income minus cost of goods sold. What's left to cover all the rest of the expenses of the business. Some business textbooks refer to this as contribution margin, because when you combine it from all of your products and activities, you're not looking at the gross profit from just the strawberry jam, right? So that's a synonym that I want to make you aware of. Gross profit by enterprise. So what's my income minus direct cost of goods sold for eggs versus agritourism versus produce, etc. Or if I'm making, cookies and cupcakes and some other, fancier baked good, right? I'm going to see different gross profits for each of those enterprises, or like prepared foods versus bakery goods, etc. And then looking at your labor expenses by week and year to date, and then net profit. So here are some of the metrics that we have talked about, some that we haven't talked about. Your net operating cash. This is that piece at the bottom of the budgeted P&L that we looked at. It's your net profit plus your additional cash inflows minus your additional cash outflows, right? The things that aren't income and expenses of the business. Your net operating profit margin, or your net profit margin, is that line on the P&L divided by sales. The difference between net operating profit and net profit is if we have those other income, other expenses that are still income and expenses of the business, but aren't direct operating. So that's where you might see like grant income and then the associated expenses of the grant, right? Things of that nature. Your current ratio, we already discussed. This is a short-term loan payoff ratio, burn rate, and then there's a few others here, right? Sales per employee, sales per acre. This breeds a whole number of different questions where you want to be consistent. Your labor to sales ratio, your average pay per employee, and then just looking at these major categories of expenses to sales, right? We talked about these 7 numbers in the chart of accounts. Even if you just ran your 7 numbers as a % of sales every month in a chart, you would see how your business is fluctuating and where you might want to implement more controls. You can also see where you might get hard questions from a lender about like, why is this inconsistent? There's a piece here on inventory turns for those that are producing non-perishable goods. And so that's there for you if you want to take a look at it. And then we have our sales per dollar of assets and sales per dollar of debt, which just tells us how we're using those assets and debt to support the business. Okay, so financial literacy review, some critical review points from this session, and then we have some time for questions and from some announcements from SDFSA. Okay, cash. We've talked about this a bunch of times. This is also really important when you're storytelling for your business, especially with a lender. Profits do not equal cash. So understanding where both of those numbers come from, how they marry, and how you find the gap is going to make you a very confident and competent storyteller about your business. You must address cash flow and find the gaps before it's mission critical. We talked about this. You need like a 3-month lead time of understanding when you might need to borrow. I'm not saying that it's not going to happen if you don't, but that's the most responsible way to approach it and like the best way to find the resources that you need. If you don't have a balance sheet, it's time to start one. Very often in this scenario where we're working with small businesses, there's some logs in Excel of revenue and expenses. Maybe there's some financial accounting systems, but the balance sheet hasn't been properly built because you've probably already invested a bunch of money in your own business and bought a bunch of equipment and things before you even sit down for financial accounting. So those records need to be gathered and inputted so that your assets, your liabilities, your equity are correct on your balance sheet. There's also mistakes that happen in QuickBooks where maybe when you're categorizing, it makes a suggested prompt to a balance sheet account that's not the appropriate account for that transaction. And so mistakes can appear on the balance sheet too. We want to clean those up. Best practices review. Bookkeeping is a constant and ongoing activity every single week. Up-to-date financials make you a much stronger candidate for loans because it shows that you have some fiscal responsibility in your business and you have some financial controls in place. If you aren't using a software solution for your books, it is time to start. It's never too early to start. I'm not saying you have to buy QuickBooks. There are other solutions out there that are meant for super small businesses in their startup phase that are either free or very inexpensive. You need a system. It's really difficult to manage this in a spreadsheet. Lender readiness review. Moving into that time where you're going to put out an ask. How much money do you need? What is the money for? Working capital versus equipment, etc. When can you pay it back? When can you pay it back? Prove it, right? Those are those financial projections that we discussed with cash flow calculations. Punch list, 3 to 5 year financial model, profit and loss with cash flows at a minimum. And then also a 1-page strategic plan or business plan if you have a more full-blown approach. Ratio analysis, critical points review. Calculate your financial ratios and look at the trends. Financial ratios in a bubble are not necessarily super helpful. You can see where you hit at one time, right? But numbers are so much more valuable in comparison against other periods of time. So if you can create like your list of your top 5 KPIs and calculate them every month, a year later, the well of knowledge you're going to have about how your business performs and how those numbers relate to each other and what's driving success in your business, the improvements will be vast in your understanding. Can you tell the story of your business and which expenses are connected to which drivers, right? So what is driving different expenses in your business? Is it sales? Is it just your choice as a manager? Is it a fixed expense that you have no control over? And how does your balance sheet play into the story? What are we not seeing on the profit and loss that's important to the story? Okay, so for our last slide, I just have opportunity to share like how you might want to use this or how you might want to share your story. And then that is the end of the presentation. So I want to open it up for anyone that has a share that they'd like to say to the group and also to be able to pass it back to Hannah to make her closing announcements and help us connect everything that we did here today.
Awesome. Thank you, Rebecca.
You're welcome.
It is open. Whoever would like to ask questions or share with us how you're planning to use this. Also in the chat, if you want to add any comments there.
I just wanted to ask if there's any future webinars that you had. This was so helpful. Oh my gosh. That little cheat sheet that you made, amazing. Gold.
Thank you, Talia. That's my daughter's name too. Thank you very much.
Oh, well, it's a very nice name. I love it.
Yeah, I'm so glad to hear, Talia, that it was helpful for you. So we had the financial literacy webinar, and this is the follow-up. We are always open to hearing what are the interests of small business, owners in San Diego of what should the next webinars and workshops be about, and then we'll definitely have more workshops in 2024. We're just not sure about what topics will be yet. So feel free to share with us some topics that interest you. You can always email me. But yeah, you can keep in the lookout for more webinars next year.
Awesome. Thank you.
There is a question in the chat, Rebecca, from Danielle.
I see that. Well, the previous P&L balance sheet templates from the previous webinar available. I think
I'm sorry.
I think Hannah said in the beginning that they were already shared out, that there's a whole folder from the financial literacy workshop, which was 2 modules. It was a full day. So it is like 8 hours of content, but it's divided into the morning session and the afternoon session. The morning session really focused on the literacy around profit and loss and balance sheets. The templates that I shared today, like the East Bend Farm P&L with the cash flow calculations, the sample statement of cash flows, and the sample small farm balance sheet, are already in the folder from the webinar today, as well as the metrics worksheet and the strategic plan template and our slides.
Yeah, sorry, I passed it to you before fully reading the question, but I
Oh,
can
that's
send
okay.
it. I can send it to you, Danielle, the full folder of the financial literacy webinar. And the recording I sent out on last week, but I can send again on the follow-up email with the folder as well. Of course.
Yeah. And I will say that the content from the literacy workshop is so much, and there's a lot of attachments, a lot of additional supporting documentation. But if you go through the slide deck, there's hyperlinks throughout the slide deck to the information that's in that folder. So it'll guide you as to like when to open all the additional supporting documents to support that piece of learning. So don't feel like you have to go through all of those documents and figure out what they are. I would start with the slide deck and then connect through the hyperlinks in the slide deck.
Awesome. Thank you. Any questions before I close this out? Questions, final comments? Thank you so much, Rebecca.
Thank you. It's really a pleasure being here with you all. I do a lot of work with individual businesses, but I really enjoy teaching these types of seminars and just knowing that there's an opportunity for like radical improvement as a cohort, as a group. So I encourage you guys to find buddies in your peer network that are also working on these things, because it always helps to have an accountability partner or another person to share learning with to help your own progress.
Yeah, hi, Rebecca. This is Jorge. I got a really quick
Hi.
question. Hi. Do lenders expect to be like paid like almost like right away, or are they like pretty receptive about paying like, let's say, start payments like a year later after you get your loan?
Yeah, I think they're all independently negotiated, and it just depends on what you're going in and asking for. Like if you can show that you need a certain number of months before the payback cycle begins and there's like clear financials laid out, it just depends on what their due diligence process is and if they allow that type of programming. But yeah, I mean, I have seen loans that are like interest only to start, or have a couple of months, or have a few months lead time on the repayment cycle.
Yeah, thank you.
Mm-hmm. I see a question from Ranchito Milky Way. What are the most common trends you see in successful farm operations? I mean, I think it varies by scale and what like the need is moving forward. But I think the most common trend that I see in folks that are successful is they actually have a written path to success. So they have financials that show where their revenue is coming from. They have those breakdowns of like how many customers and average order values and understanding a pathway to get there. And then they can see what profits will be and how they're planning to grow profits over time. Usually it relates to that business having like a really well fleshed out marketing program that's going to get them where they want to be. Whether that's just having a few key wholesale customers, or, you know, as in your case, like building up a larger base of CSA customers, to really understand where the revenue is coming from, how they're going to capture it, and then what their expenses look like. And then knowing what scale their business really needs to be to get to that viable point of personal income, right? Like if I'm a farm business owner and I'm only making $15,000 a year, that's not long-term viable. So what is long-term viable for me? What scale does my business really need to be to get there? And then do I have the resources I need to get the planning and marketing support to get it to that scale? And then to be honest, it's like asking yourself that question in the magic mirror. Do I really want to be that scale? Because I've definitely worked with farms that needed a significant scale up in order to have the level of income needed for the owner's like sustainment of their lifestyle. But then when we got there, you know, looking in the mirror, they're like, I really don't like it here. I liked it much better when business was super small and I was on the tractor and I was in the field. Now I'm managing people that I can't necessarily depend on, dealing with employee turnover, managing the books, really doing more of like an admin and marketing and management type of job. And that's not what they wanted. So I think to be successful, it's like making sure all those pieces come together and that you're resourced to make it happen. I will say the number one reason farms fail is lack of profit. So they may borrow and build their asset base, but they don't have the profit to cover it and be able to pay back that cash flow. I think it's a lot easier to identify why farms fail than why farms are successful. But I already think I said, like, you know, what I have found that I see that is going to lead us towards more success.
Awesome. Thank
You're welcome.
you. Thank you, everybody. So I'm going to close us off just sharing a few slides about, just a second. But yeah, thank you so much, Rebecca. We'll definitely, you know, we're always working with Rebecca through the Kitchen Table Consultants in different ways. So we'll see what comes for 2024, but our partnership is only getting stronger. So thank you so much for bringing.
Thank you so much for having me. It's like, it's a pleasure to be here. It's an honor to have you all like listening and contributing and, you know, taking home your next steps. Thank you for giving me the opportunity.